Good evening, everyone, and welcome to Calamatta Cuschieri's investment webinar, which will be talking about our market predictions for 2021. 2020 turned out to be a very active year for the markets, where the pandemic created considerable market swings and huge opportunities as a result. Today, several sectors are sitting at all-time highs, whilst others are still recovering. And the questions we are being asked are, where do we see the markets heading in 2021? Will tech continue to grow? And how does one find value in the markets? For now, I'm going to be joined by two guests at Calamatta Cuschieri, Jordan Portelli, Chief Investment Officer, and Christian Kamenzuli, Investment Manager. Later on, Sergio Bellizzi, Head of Retail Distribution, will join us for the second part. So let's jump right in. Jordan, I'm going to start with you. 2020 was an explosive year for the markets, which returned some huge gains and saw markets at all-time highs. Which sectors benefited the most, and what was the reason for this?
First of all, thank you for today's invite, John. 2020 will be marked in history as a year in which we were surrounded by huge uncertainty, which ultimately this uncertainty surrounding economic sustainability, but also our well-being, turned obviously to be a year in which markets were highly conditioned by this uncertainty. It was a year in which obviously we've seen remarkable swings. However, it also turned a year of opportunities in which those investors who traded those swings were rewarded remarkably. You've mentioned sectors. Again, 2020 was a very good year for the tech sector. The tech sector also performed very well in 2019. And in 2020, the pandemic turned out ultimately to be a positive driver for the tech industry. If we had to look specifically and be more specific within the tech sector per se, we've seen stocks which are linked to e-commerce trade remarkably high. We've seen companies such as Shopify, which was up 178%. We've seen also Amazon doing really well with an 80% gain for 2020. But more interestingly, were the correlated sectors which benefited from the gains we've seen in the e-commerce business, such as the freight and logistics sector. In fact, there also we've seen a positive trend, a trend which continued also in the last 2 months of the year, despite we've seen some positive news from the vaccine front. And there we've seen companies such as FedEx, which was up also by around 68%, but we also have seen companies such as UPS, which also traded highs with highs of around 40% for 2020. So all in all, as I've said before, 2020, a year of uncertainty, but also a year of huge opportunities for investors.
Okay, thank you, Jordan. You seem to mention the tech sector and the freight and logistics sector. Chris, where do you see these same sectors end up in 2021?
Well, in 2020, when we started to discuss where we expect the markets to be, most of the stocks and sectors which rallied in 2020 were the stocks which we expected to do well during the year. What happened was, though, the percentage increase we've seen in these stocks was much higher than we originally anticipated. So if we were thinking artificial intelligence, if we were thinking cybersecurity, if we were thinking green energy, if we were thinking electric vehicles, all of these themes were being priced in the market at a much faster pace. And the reason for that, like Jordan mentioned, the demand for tech due to the COVID-19 situation led to a huge boost in these stocks. But it's very acceptable and understandable also, because the fact that people move towards these products and the need, for example, for cloud computing. You can imagine a business that wasn't set up as it should be. Out of its employees were working from home, and obviously it needed to hurry up in the way it operates to make good for this new technology. So what we were factoring in our model for sales to come in the future years were happening this year. In fact, we can even relate it to a local company. If you look at Beemit, for example, and you look at its cloud business, its revenues in cloud increased 50% this year. And obviously, this positive trend in tech, we could see across the whole sector. In fact, the Nasdaq was up 43% in 2020. And that's no joke, looking at the previous years where the tech sector was a strong outperformer. In fact, what we expected was that there would be growth, but not at this rate. And even going forward, we expect that this sector will continue to do well. Take, for instance, Amazon, which was up 80% in 2020. Now, Amazon is one of the ideal companies. One, because it manages to adapt to change. For example, if you think of Amazon, a lot of people think an online retailer, but it doesn't stop there. In fact, some people think Amazon is expensive because of its business, which is online retail. If you just stop and think of that, then maybe yes. But Amazon took the advantage of moving into other businesses, whether it's cloud business, whether it's online grocery. And even if you look at the pandemic and think of people at home, what did they need? They needed cloud, they needed online grocery, and they needed online shopping. And it was the perfect mix, the perfect basket, the perfect company. Although there were companies which did better than Amazon as a year performer, it was a safe stock and a safe bet for 2020. So moving on in 2021, and to answer your question, yes, I believe that the sectors which did well, be it the tech sector, even consumer discretionary at the end of the day did well if you look at the All World Index, and the communication sector and the materials sector. We expect that these sectors will do well, maybe not at the rate they did in 2020, because like I said, that was being priced in. But again, this new reality hit a lot of individuals and businesses, and a lot still need to adapt to this new reality, which is the future. So I believe yet the winners of 2020 will continue to be winners of 2021, plus other sectors which did underperform will start to recover in 2020, will continue to recover in 2021, but these teams are still our teams for 2021.
I think if I may add to Chris's comments, an interesting view which we were surprised with to a certain extent is the fact that following the volatility which we experienced in March, April, May, we've seen instances where cyclical stocks which were directly hit by the pandemic continuing to negatively perform, while the tech was acting as a hedge when markets were negatively performing. But once again, the tech sector emerged as a hedge in instances where we were being faced by new volatility as the COVID developments.
So it was towards March, April of last year?
Yeah, it was March, April, and May also, the second quarter.
If I may also, you could see Apple, for example, which was up 80%. Now, Apple launched a new iPhone, which is the iPhone 12, and there was a hype for this iPhone because it led Apple into the 5G technology. Again, 5G is a sector which is something which a team which we're investing in 2021. Now you would say, why would Apple do so well in 2020 when at the end of the day it's not an Amazon, or it didn't cater for the needs of the individuals which were at home? Having said that, Apple has over 200 billion in cash on its balance sheet, and with that cash, it gives this type of company the opportunity to take advantage of those companies which maybe are at its knees, or maybe gives the company time to rethink of how it can grow going forward, and give the shareholders exactly what they wanted, that change which we've been seeing. In fact, we've seen Apple talk to Hyundai regarding electric vehicles, again a theme which we've been talking about for 2021, and again it gives the company this opportunity to look forward and push their agenda to create wealth for shareholders.
Okay, very good, thank you very much. Now let's talk about those sectors which lagged behind, okay? Jordan, in 2020, which were those sectors that lagged behind?
Expectedly, the sectors which lagged, obviously, are those sectors which were directly impacted by the pandemic. So if we had to look at particular sectors, obviously the travel and leisure industry was one of the sectors which lagged the most. Obviously, it wasn't surprising because, as I've said, it was an expected event that, given the restrictions, for
Travel
instance,
bans and lockdowns.
yes, airlines, etc., would suffer the most. What we also need to take into consideration is the fact that there were state aids which obviously mitigated that impact and also triggered some sort of confidence within the markets. In fact, we had, for the first time in a decade, a primary market which was literally inexistent. This was in March. We all have seen companies such as Carnival, which needed liquidity, emergency liquidity, which tapped the bond market at a high rate of over 12%. We're talking about a company which it was at that time an A-rated company and was downgraded subsequently because obviously because of their business model due to the pandemic. But then we had also other sectors such as the banking sector, which was also impacted on the expected credit losses due to the pandemic. So what we're saying here is higher employment, lower disposable income, okay? So obviously there will be people or businesses who would default on their loans. So we had also that aspect, and we've seen big banks taking huge provisions, okay, which were higher than 2008 to safeguard the possibility of these credit losses materializing. So despite we've seen a recovery in the last quarter in these more cyclical sectors, okay, they still lagged when compared to the tech industry and other industries which performed well. And as Chris pointed out, these particular sectors might be the opportunities in 2021, okay? So if we are constructive about a normalization event due to the vaccine rollout, these sectors might be, as I've said, performers in 2021.
Okay, and specifically you mentioned the travel industry and banks as well. Is there anything you need to add from your end, Chris, about this?
Yes, if you look at the all-world index and you look at the worst performers, the one which is flashing in red in 2020 is the energy sector. Now, the energy sector was down over 30% in 2020. Now, the question is, do you see this as being attractive moving into 2021? As we've been seeing, even the price of oil at one point in 2020 went into negative territory, now bounced over $40 per barrel in the price of oil. And so we have seen a recovery also in these oil stocks. In the short to medium term, we're positive on these oil stocks like Total, oil stocks like Eni. And we believe that going forward, seeing that the economy, and we do expect a recovery in the economy, that's also important and ties in with our positive outlook for 2021, does sustain an investment in these companies. Though I said we're positive in these stocks in the short to medium term and not in the longer term, because we believe that at the end of the day, we're phasing out of the traditional energy companies and moving towards more greener energy companies. But if you had to really think about it, it could be that these traditional energy companies will be the winners of the clean energy companies, because again, I mentioned Total and Eni, two companies that are investing a lot in wind energy and how to come up with sustainable energy. And they're not just sitting there and they know that the future is green energy. In fact, if you look at green energy as a basket of goods, we're up over 100% in 2020. These companies are not just sitting there and doing nothing, they're actually moving forward. And even the fact that Biden won the presidency in the US, again, a promoter of green energy, so these companies will obviously try to get on board in order to benefit from any policies he will come out with, in particularly oil and gas. He mentions also the banks. That's true. We also spoke about, for example, the savings rates, which should be coming down. Obviously, even in Malta, we see that a big drag on the banks is the fact that the deposits have shot up. That's a cost for the banks because they have to pay the ECB to actually hold that cash. The fact if deposits come down because people are spending more, it's good for the economy and it's good for the banks. And so for the banking sector, I don't have much more to add than what Jordan said. Regarding travel and leisure, there was a lot of talk by customers and clients regarding the cruise liner business and regarding the airline business. I'll start off with the cruise liner business. I mean, at one point, it was when the markets were selling off due to COVID, it was a pretty scary scenario because companies were down 80%, if not more, and that creates a liquidity crisis within these companies. Obviously, they couldn't operate, they had expenses, some of them had to sell some of their ships in order to survive. But having said that, there are winners also within all of this, and the company which a lot of investors are talking about at this point in time is Royal Caribbean, and we've seen a nice rebound also in the shares. One, because there was a forward-looking statement from the CEO saying that they're seeing a huge flow of bookings coming for the future years, which is a positive. But what's most important and what led to the rebound we've seen in the share price is the fact that they managed to refinance a lot of their debt. And if they didn't manage to refinance this debt, that would have been a huge problem, obviously, because it would have been game over for the company. So for the cruise liner business, something which the market is talking about and which is the second largest cruise liner is Royal Caribbean. Regarding the airline sector, the airlines as well had a huge rebound, as we've seen from their lows. Having said that, we believe that now the market is pricing in around 89-90% of 2019 revenues, which are going to be recouped by these companies going forward. So it could be that they did shoot up over the short term a bit more than expected. Having said that, if the rollout of the vaccine is fast and people get onto their new lives back at a faster pace, then obviously this will be sustained in the share price. But what we do talk about and what we do prefer when we talk about the airline industry is more the manufacturers. So it's Airbus and Boeing. Now another question which is asked is, which do you prefer, Airbus or Boeing? Personally, I prefer Airbus to Boeing on the fact that we all know that Boeing went through the crisis of the 737 MAX. Yes, in November, these grounded aircraft managed to fly once again, and we've seen a rebound in the share price. But that hit on the company's reputation will remain. In fact, Boeing saw around over 500 orders for the 737 MAX being taken off by their customers. So that's one reason why I particularly like Airbus to Boeing. Another reason is what we've been discussing as well internally, is that the increase in load factor or the increase in flights we've been seeing is in short-haul flights, especially in the US. And if you look at the competitor of the 737 MAX, if you look at Airbus, they produce the A320. And obviously we expect a pickup there in the A320, given the fact that obviously, yes, companies do make mistakes and people do move on, but they don't forget, and it could be that they do move to Airbus. So all in all, both companies are trading at attractive levels despite the rebound. If you do believe that going forward, I mean, the rule of thumb or what the market is pricing in the airline business and then even in the hotel business is that we're back to 2019 levels in 2023. We've heard this by foreigners, we've heard this even locally. And if you believe that this is the move forward, then the prices should be maintained and we should see a slow pickup again in these companies.
An interesting point to add to Chris is when mentioning the airlines, and he've mentioned specifically US airlines, we've seen some encouraging figures in the last 2 months of the year of 2020 in terms of passenger movements. Why? Because as opposed to the previous restriction measures taken by the authorities by placing people who travel in quarantine, they were being tested on arrival in airports. So we've seen some, as I've said, encouraging passenger movements, especially in what Chris mentioned earlier in the short-haul flights. And we've seen some encouraging figures specifically by American Airlines and United Airlines. So I think, to add to Chris, I think if we believe that we will get to pre-levels, okay, we believe that there is still some room for the airline business to perform in 2021.
Okay, very good. Now we're moving on to specific names in the equity market. Which big names performed the most in 2020?
Well, I'll kick off with the 5 top performers of the S&P 500 because the S&P 500 was up 16% in 2020. And I'd like to highlight also the fact that the Euro 650 was down 5. And the main reason for this is, like I said before, the Nasdaq was up over 43%. And if you look at the breakdown of the S&P 500, we have double the amount of tech that there is in the S&P there's double the amount in the S&P than there is in the Euro 650. So if there's 30% tech in S&P, there's 15% in Euro 650. So even just by looking at that, you tend to see that the S&P should do better. Also, if you look at the financial exposure, there's more financials in Euro Stoxx 50 than there is in the S&P and the S&P 500. But it's not just that, because even the S&P has, if you look at the US financials, they outperformed the European financials in 2020. But moving on to the top stocks of 2020, the number one stock which outperformed and left many, is Tesla, which rallied around 750% in 2020. Now, even if you look at what happened last week, we got to know that Elon Musk is now the world's richest man. But what brought Tesla to where it is today? First of all, in 2020, we've seen Tesla hit the S&P 500, so it's part of the S&P 500. So what you have to think about, every ETF that tracks the S&P 500 or every fund that has exposure to the S&P 500 will start to tap into Tesla. So that alone pushes up the share price. We've had a share split in Tesla. We've also had Tesla become the top or the most valuable market maker in the world in just 1 year. And what's important though is before the markets were worried that Tesla won't be able to supply as much cars as the market was expecting. Now there are two problems at these levels, because obviously the more the share price goes up, the more there's demand, expectations by shareholders. And the expectation which is added now is profitability. So before it was loss making, and now the company started to make money. But what they want to see is the margins start to improve at a much faster pace. And in fact, Elon Musk himself said that the company will get slaughtered from these levels if they do not deliver. So a lot of weight on his shoulders, but then again, he's the richest man in the world. So, I mean, fair enough. Moving on to the second best performer in the S&P 500, here we have a company which is maybe known or not, but by many is known as Etsy. And Etsy is a company which you could say is a competitor to a certain extent to eBay and Shopify, but then again it has a niche, and that's what makes it special. So it's a company that invests in artisan products and vintage products. In fact, to be a vintage product, it needs to be over 20 years old, and these products are sold on its platform. Now think about it. I mean, we talked about Amazon, we talked about online retailers that did well. So people would buy into online from their home these products. But think about it, it happened locally as well. A lot of companies would push or the propaganda would be buy local. Imagine buy artisan goods. So again, Etsy provides artisan goods, and there was a strong demand for their products. Also, what led to the share price where it is today is the fact that they let their customers promote on other methods of media, for example, Facebook, so they could move out of Etsy to promote products of Etsy. And we've seen the company actually increase its outlook twice during the year, in a year which was a difficult year for a lot of people. So again, a huge outperformance there, the share price over 200% in just 1 year, a great company. Moving on to another company which did very well, over 200%, is Carrier Global. Now this is a company which invests in heating and cooling of goods. Now think about it. The vaccine needs to be transported and kept at a certain temperature. And they provide this. They provide the mobility of goods in a certain temperature, apart from heating and cooling of offices and commercial spaces. So again, you can imagine how and why a company like this should do well. Again, 300% in just 1 year. And the last two companies, which are more known companies to shareholders, NVIDIA, a company which is a semiconductor company, and has done extremely well. It has done extremely well because it produces a chip which is used in the gaming, and a lot of people, again, from home, have more time to in their free time using gaming. Something which is of interest, a lot of people talk about Bitcoin, talk about cryptocurrencies. Cryptocurrency miners use their chip in order to mine the currency. So again, a huge demand there. And also, we've heard that they're teaming up also with NEO in order to work together. Again, the EV business ties up this company. So yes, obviously, I do see this company do well also in 2021. The last company to mention 5 is PayPal. PayPal, again, people spending a lot from home through electronic means. They provide the service, and it's fair enough that this company has done very well in 2020.
Okay, one would think Career Global still has room to grow in 2021 as the vaccine rollouts take place.
Exactly. So at the end of the day, yes, they did perform really well in 2020, but the team still stands. I mean, and what they do is something which hopefully they continue to evolve, because a company does well, its margins improve, it increases its cash pile like Apple did, and with that they can move into other forms of business, because if a company doesn't evolve, it continues to produce the same product, then you're in a situation where obviously you don't create value for shareholders, and you could easily get wiped out and an investor moves on to the next best thing. But if they do evolve, like I had mentioned, Amazon, then yes, there is scope for that. I remember a time when no one would want to buy Microsoft anymore. Once they found the niche in cloud computing, then it became the next star. So if the company can evolve, shareholders will follow.
Thanks, Chris. Something which a lot of people were talking about towards the end of 2020 was the Airbnb IPO. What do you think about the share, and where do you see it heading?
And now Airbnb more than doubled when they launched the shares. Now the shares came out on the 10th of, they started trading on the 10th of December at $68 per share. At one point hit over the $163 per share, and is now settling around the $148 per share. Even that, if you think about it, the share price is at 100. Okay, it came off its.
But it hasn't changed much since.
But at the end of the day, it is at $148. And if you look at the price targets out there, it's pretty much in line with where the market's expected to be. Now, it was quite amazing the way the share price moved at open. But having said that, it shows you how important it is that a person feels comfortable with the company. Now, looking at Airbnb, I mean, everyone knows Airbnb, and that's the first important thing. I remember a client saying, for example, he would buy Netflix, and I say, why did you buy Netflix? He said, because I'm at home, I see it's really convenient, I put on the TV, but there's no valuation to that. And I say, but what about the valuation? But even with, so the very first thing is feeling comfortable with the company, because you can have a great valuation if a person doesn't feel comfortable with the company or doesn't know it. He could shy away from it and doesn't help in actually finding the true value of this company. Now, what pushed the share price up, and do we expect it to improve going forward? Airbnb has a competitive advantages compared to its peers, obviously, because it has a much larger network, and that gives it the privilege to be trading on the multiple it's trading on at this point in time. Having said that, is the privilege that high? Because if you look at the price to sales ratio the company is trading on 2022 sales, it's on a multiple of 17 times compared to its peers of just 5 times. So that is expensive. And I'm talking about the price to sales ratio here because the company is loss making, and it's expected to remain loss making
for the foreseeable future.
Exactly. So again, I mean, should it be trading on these levels? It depends. Will the travel industry recover much faster? Because if it does, then we would expect the share price to keep up a positive momentum, not obviously the momentum we've seen since IPO, but then again, it shows that the price it traded on, because just looking at the price and where it is today, it showed that it offered value to shareholders at IPO. And this is very important, that at IPO, the company gives something to the shareholder as well, and that rebound, the fact that price targets are there, makes it show that there wasn't the greediness to not give something to shareholders.
To add something on Airbnb, I think the interesting bit going forward for DNB is their geographical positioning. To date, they haven't as yet tapped the emerging market region. It is a fact that there is huge potential. Expectations in terms of revenue streams for Airbnb by 2030 are of 40%, with growth being driven by China and India. So if we believe that this growth from this particular region will materialize, obviously we see value in Airbnb going forward too.
Okay, fantastic. Thanks a lot for that. Next up, guys, people want to know what your top picks are for 2021. Maybe you can give us about 5 each.
Yes, I think we spoke a lot also into the introductory part about the EV sector. It is a sector which is gaining popularity on the fact that there are clear timeframes in terms of transition towards cleaner energy. And we've seen many companies trying to take the first mover advantages within the business. As Chris pointed out earlier, this week we've seen an announcement by Apple which it might partner with Hyundai, the South Korean auto manufacturer. The share price on the day for Hyundai was up 23%. We've seen also yesterday or 2 days ago, we've seen Baidu, which is the largest Chinese search engine company, which is exploring the possibility of venturing with Geely. Geely is a privately owned Chinese manufacturer which coincidentally also owns Volvo cars in Sweden. And there again, both companies are looking to the possibility to start producing electrical vehicles going forward. So I think this is a very interesting sector. We've been looking at the sector over the past couple of years. Popularity for this sector has increased. For those investors which are not comfortable into taking literally direct positions, they might also be exposed to what we call exchangeable tradable funds, ETFs, which track these particular companies. For those who are more constructive on specific names, there are companies which we've mentioned Neo several times. There's a clear execution plan there. The company is doing well. Contracts are being signed. Okay, and for those investors which are more comfortable with the more names which are more known to the market, we also see opportunities in auto manufacturers in Europe, such as Volkswagen. First of all, Volkswagen is a company which has a strong product brand. The brand, as we are all aware, is very strong. Cash-wise, we have a clear stream of free cash flow, of positive free cash flow going forward, which is good for credit holders, but also for shareholders. And ultimately, they're also tapping and shifting their business towards the EV space. So in 2021, Volkswagen's exposure to the EV space would be around 6 to 8%. By 2030, their plan is that to be at least 30% of their business. So there we're seeing also European manufacturers which are also tapping the EV space, okay, on the premise that as I've said before, especially the auto industry generates around 28% of the carbon emissions. Okay, so I think it is a sector which has not, as Chris mentioned earlier, the short to medium term trends, but more to the has more longer term prospects. Also, if we had to look, we've mentioned a lot the short term gains which we see in the oil and energy industry. for those investors which would like also to tap the M space within the oil and gas industry, a company, a very well-known company is Petrobras. Petrobras is 50% owned by the Brazilian government. We've seen Petrobras going through some corruption scandals over the years. In 2014, it kicked a restructuring process, and we see this rather than only a macro story, more of a bottom-up approach story, because through this restructuring process, they are disposing of assets which will ultimately deliver their business, so which ultimately is also seen as a positive for shareholders. Production for 2020 was a record year of production for Petrobras. When compared to its peers, it is seen as a cheap company. So ultimately, these are obviously companies which we obviously like, and we see a pickup in the short term. But as Chris pointed out, it is the traditional energy stock which will be there in the short term, make money, and then obviously reconsider more longer trends.
Jordan, you mentioned NEO. A lot of clients ask, is it NEO or is it Tesla? Where should I invest? Now, if you look at what the market is expecting for NEO, I mean, where it's trading at the moment on the $60 level, there is quite consensus there when it comes to the price target, and it seems to be quite fair value. When you look at Tesla, on the other hand, the market is very divided. I mean, there are certain analysts that think that the share price is worth 800. Now, the share is around 850 at the moment. But there are other well-known analysts out there that believe the company is worth $100, $200 per share. So there's a huge discrepancy in the market of where they see this company. And it all depends on the company delivering on what the market is expecting. So the market is expecting a lot. If the company does deliver, then yes, it will maintain this momentum. So it all depends. The winners in the portfolio will all depend on if the company does deliver.
Also, to continue in terms of discussing what we believe obviously are our top picks, we also like another bottom-up story, which is HSBC. HSBC is a bank, which a well-known bank even amongst us locals. They have also their presence here in Malta. But what is interesting about HSBC and not about other European banks is that HSBC kicked a restructuring process to shift their business to more interest generation in terms of revenues. So this is something interesting. We've seen 2019, if we were to look at the operating income for HSBC in 2019 from Europe, it was returning a negative level. So we like the fact that HSBC is shifting into Asia. And if we were to look where into Asia, we've mentioned China before, okay? There, if we were to look at the loan prime rate, the 1-year loan prime rate, it's at 3.85% at this point in time. So it is clear that in terms of interest income, HSBC will benefit from that end. Okay, and to mention another bank which we like, Bank of America, it is a rate-sensitive bank, but if we are constructive on a recovery in 2021, and if we believe that we will, in the US, start facing possibly reflationary pressures, Bank of America is a bank to invest in because it will ultimately, without any doubt, benefit from these reflationary pressures.
Okay, and from your end, Chris?
I'll put down the team and the names which we believe will do well in 2021. So if we're talking about cloud computing, there we see Microsoft and we see SAP. SAP is a European name, which we expect to continue to do well in 2021. If we're talking about online retailers, and we do expect the brick and mortar retailers to recover, but I think this new normal will stick. So companies like Amazon and Alibaba, particularly Alibaba, because we've seen the share price come down because the company was under attack due to the fact that they had some issues regarding the way they sign contracts with their customers. Though if you see the impact of this on their sales, it's pretty negligible. It all depends on if they were given a fine, what would be, hence why the share prices come down. But that could create an opportunity at these levels. So online retailers, Alibaba and Amazon, not just online retailers, but also in cloud. And Alibaba is copying Amazon and a lot of things it does in the Chinese markets. And from a demographic perspective, we also like, obviously, China is one of the regions we're investing in, so Alibaba is good. When we're talking about clean energy, green energy, we're talking about Schneider, a company that is investing a lot in green energy. A lot of companies, which are traditional companies, you wouldn't expect, because you think about green energy, you think about something new, and you'd want to come up with a new name that you haven't heard of. But a lot of companies which we do follow are actually investing in green energy. Just like Jordan had mentioned, Volkswagen, again, a company which is a traditional combustion engine company, again, investing in EV to compete with the likes of Tesla. So if we're talking about that sector, those are the stocks. If we're talking about energy, like I said, we like Total and Eni. So we continue building on to the different sectors, which we like moving forward. And if we're talking about the semiconductor business, then it's ASML and NVIDIA. Again, NVIDIA had an excellent year last year. We expect it to continue to do well in 2021. There are many more stocks which you could mention. We do issue our CC equity list with the top stocks which we do like and which is available for our customers, so we could spend all night speaking about
I think that's enough.
Which we like.
5 each is very good. I'm sure everyone's going to be happy with those. Now, moving on to a regional perspective. Okay, Jordan, from your end, what is your favorite region for 2021 and why?
We've mentioned a lot the emerging market space. First of all, I think a step back, we see the possibility of an economic rebound more realistic in the US. We've mentioned the US before, so US is one region which we will continue to form part of our portfolio. But more specifically, we've mentioned emerging markets. If we believe normalization, capital flows will ultimately be also present strongly in emerging markets. Specifically, we like Asia within the emerging market space. More specifically, we like China. We like China not only in the short to medium term, but also over the longer term, on the basis that there is a clear strategy by the Chinese government to become self-sufficient in the next 15 to 20 years, driven by domestic consumption, which at this point in time is pretty low. But we've seen that these initiatives taken by the Chinese government to stimulate also a shift from the lower class to the middle class will ultimately result in remarkable consumption, which will ultimately translate into self-sufficiency for the Chinese economy. So specifically, we believe that China is one region to position ourselves. Chris mentioned Alibaba. We see Alibaba also in line with domestic consumption. We've seen this happening and we will continue to see this going forward. So all in all, we believe that in terms of recovery, these particular regions will benefit the most.
Don't forget that even where we've seen 2020, a lot of countries come up with negative growth rates. We expect China with a 2% growth rate.
Exactly. So as Chris is saying, China will be the only country that will register a positive growth for 2020 of 2%, and the forecasts published lately by the OECD are pointing for China towards a growth of around 8%. So yes, it is a fact that they were very, very agile in controlling the pandemic, which ultimately resulted in something positive.
Okay, now let's move from China to Malta. What are your views on the local market and the local dynamics?
Obviously, inevitably, we were also conditioned by this pandemic, as other European countries, not only European but globally. It is no secret that our economy is highly dependent on the tourism industry. If we had to look at the gross value added of the tourism industry thus which it impacts other sectors, it accounts to around 30%, 28 to 30% of our gross domestic product. So as opposed to years in which we've seen the local economy outperforming other big nations, it is a year in which obviously Malta will register one of the worst negative growths in a decade. Having said that, also we spoke about our optimism going forward through the rollout of the vaccine. We believe that in the second quarter of 2021, Malta will start rebounding. And when we're saying a rebound in an economy which is highly dependent on tourism, if we start seeing passenger movements, tourism inflows, the rebound will be a strong rebound. So let's also look to the local economy with optimism.
Okay, very good. And Chris, any names you like locally in particular?
Yes, something which we've seen in 2020 is that the local market is not immune to risks, global risks. So we've seen positions in certain companies which sold off and others rebounded. In the difficult times, the winners, we've seen companies like PG, which has a nice dividend of over 2% and a very strong business model, a company which we continue to like and believe that the outlook for this company continues to be a good one. Even its diversification is interesting, both in the retail business and in the supermarket business, and the potential for growth there if eventually they expect to continue to expand. Other companies which we like is Beemit. Again, we said this company invests in cloud and also has a very attractive dividend yield, net dividend yield of over 4.5%. And talking about, I started off by saying one of the things which we like is artificial intelligence. They actually got a shareholding in EBO, and the EBO actually invests in artificial intelligence, again, something which could continue to see the share price increase if EBO does well. A lot of companies out there in the local market, like Malta, gives a dividend yield of close to 3%. A lot of companies which we like, which pay an interesting dividend. So if we have the bond market, which could be yielding low returns because of the prices having come up, maybe these companies like PG and Malta, which have very low volatility, okay, we're not talking of the likes of RS2 here, which is a company which we do like, but doesn't pay a dividend because it's a growth story. And there we could continue to see growth. In the payments business, we said that one of the top 5 performers of the S&P 500 was PayPal, RS2. In the payments business, all we need from RS2 now is more clarity with shareholders in order to understand better where the company is going, what the company is doing. Obviously, the share price has come up a lot, and we need the company to promote its business better for the shareholders to understand the business model much more. And last but not least is MIA. We've discussed MIA at length many times.
We're talking about a monopoly story here.
Exactly, and the fact that the share price has come down gives an opportunity for someone who missed the boat on the way up to pick up the stock at more attractive levels.
I think to sum up, I think for the first time over the past years, the pandemic has triggered a reality check for local investors. So we were also accustomed with very, very low volatility in the local market, but the pandemic did trigger a reality check, which I think ultimately is also beneficial for our investors to obviously also seek these opportunities as with foreign markets when volatility took off.
So Jordan, moving into bonds in 2020, central banks continued their easing measures, which were very supportive for the bond market. Is it a good time to invest in bond funds at the moment?
Historically, historical trends show that when central banks were accommodative, the bond market performed well. So theoretically, to answer your question, if we believe that central banks will continue to be accommodative in 2021, and this is our belief, the bond market will continue to perform well. However, we have to be also mindful of the possible inflation threats which we might experience going forward in 2021, predominantly in the US. These inflation threats which will ultimately condition government bonds. And what to look at government bonds, we're not that constructive on government bonds for 2021 because of these inflationary threats. However, if we look within the asset class, within the fixed income asset class, there are other segments which are less sensitive, such as the high yield market. Okay, so theoretically, also the high yield market is less sensitive to these inflationary threats. So we believe that if an investor selects a strategy which is actively managed, that is, the manager is actively positioning himself to mitigate these inflationary risks and take opportunities, okay? For instance, within the high yield market, okay, on the basis that also the economy will improve. So ultimately, an improvement also in corporate profits for these risky companies, which will ultimately translate in better credit metrics. We believe that the bond funds in 2021 also hold a position within a portfolio. We're expecting a growth, total return of around 3.5 to 4% within European high yield growth, slightly better returns in the US given the spread differential, and also emerging markets still offer a slightly higher premium on the basis of political and liquidity risk. So to answer your question, actively managed strategies within the bond fund space, yes, they do make sense within a portfolio for 2021.
So Jordan is mentioning inflation risk. To a certain extent, inflation risk is a good thing because it's on the back of an economy that's doing well. In fact, our forecast for the US economy is expected to pick up in 2021. And also a strong rebound, like Jordan previously mentioned, in China. Now, just to see, if you were talking about the US, if you look at the US 10-year Treasury, is trading around 1.16%. That's a big discrepancy compared to the yield we're seeing on the 10-year bond, the German bond, which is yielding minus 0.47%. Now, if you look at the growth expectations in inflation for the US, we're going to go close to, if not above, the 2% in 2021. In Europe, we're way behind. And growth, even from a corporate perspective, I mean, companies' profits don't grow. I mean, sales don't grow if there isn't inflation. So inflation is a positive, but at one point could be a negative. So what we want is a balance. And
I think the real threat would be that inflation expectations will ultimately, translate into positive real rates. So if we had to look at the US economy, real rates at this point in time are negative. So if we have tangibility in terms of increase in core inflation, that would ultimately become an issue. So what we're seeing is possibly a higher yield on the 10-year Treasury to around 126, 127, but until actual inflation kicks in, we believe that possible inflation expectations are also capped on the basis that ultimately the Fed still has a lid on his monetary actions going forward. So despite there are these inflationary trends, as Chris correctly pointed out, the economy is also dependent on this possible inflation in terms of growth. Something very interesting to point out is the fact that as opposed to historical trends in which we've seen a savings rate which did not exceed abnormal levels, if we had to look at the US, at the peak of the crisis, savings rate have shot up to 33%. I'm talking here about personal savings rate, household savings rate. We've seen a dip as consumers were more constructive on the economy going forward, so that resulted in consumer spending. Let's not forget that consumer spending is critical for the US economy because it accounts for 2/3 of gross domestic product. So if we see that savings rates will continue to decrease, to normalized levels which are about 10 to 11%, that is something positive in terms of economic growth, But then we will start being more mindful about these inflationary threats, which we discussed earlier.
Okay.
Don't forget that when the markets corrected in 2018, I mean, Jordan mentioned the inflation going up, the 10-year yield going up to 1.27%. We had the 10-year yield shoot up over 3% when the markets crashed in 2018, and inflation risk was real. So we're nowhere near those levels where we believe that the market is at risk of a strong correction like we did at the end of 2018. So inflation risk to a certain extent at these levels is something which we need, because we need the economy to get back on track.
Okay, thank you very much, guys. One final question, okay, Jordan. Looking into 2021, how should the global macroeconomic environment shape up when considering the strong efforts by governments across the globe to safeguard the economy?
I think 2021 is a year of normalization. We're coming from a very difficult 2020. So with the measures taken by both monetary politicians, central banks, but also fiscal stimulus by governments, okay, I think those were crucial for a better 2021. The positive news emerging from the vaccine in early November or late October was obviously another boost, and as we've mentioned and discussed before, we saw a huge hype in financial markets over the past 2 months of 2020. So if we believe that the rollout of the vaccine will be there without any disruptions, okay, we believe that 2021 will be a good year. So in a nutshell, let's be very optimistic about 2021. We are expecting a rebound. We are more constructive globally. Having said that, we must be very mindful about particular stocks, which one should pick out. We've mentioned a lot of stocks earlier, as we believe these stocks, despite they might lag in 2020, they will ultimately become the outperformers, eventually will be the outperformers in 2021. So all in all, let's be optimistic. We are very constructive on the economy going forward, and I think 2021 will be a good year for the financial markets.
That's great, guys. Thank you very much. Now let's bring in Sergio to tell us more about investor trends and how they make use of financial planning. Okay, thank you, Sergio, for joining us. There has been a growing interest in stock markets in general. Calamatta Cuschieri's online trading platform, CC Trader, has grown by 250% in 2020. And we have also experienced exponential growth in full-service financial planning across our branches. Sergio, can you tell us more about the ways that investors have been gaining exposure to the markets, and is there one particular product that they like the most?
Okay, it's an interesting question, John, thank you. First of all, when markets go through what they have gone through, there is always the initial shock for investors. So we saw in March particularly investors taking defensive positions, going into cash. But actually the winners this year have been investors who have been actively participating.
Okay, so not those that were sitting on the fence.
No. Clearly, when interest rates in banks and the environment in general, as my colleagues have shared earlier, are at the levels that they are, the worst thing one can do is sit, basically. So we saw those investors who particularly did very well this year were the ones who actively participated, and most importantly, those who have actually used a technique called drip feeding, whereby they actually went into different moments in time throughout the year, which is something that our financial advisors actually excel in terms of the recommendations that we provide, and they would be buying into the market at different prices. That made a lot of sense this year, and we felt that it's the way that customers actually gained more over time.
To kind of like counteract against volatility.
Absolutely. Also, you asked me an interesting question around what customers were interested in. As you said, for those customers who really like self-service, online, quick trades, particularly on the equity market, which was on fire, there is CC Trader, which is an online platform which did very well. When it comes to advisory, which tackles those customers who want face-to-face advice, we found that there were a number of customers who wanted to go into shares directly. This was quite unique because typically the Maltese investor likes income, likes things that are quite cautious and for the longer term. And we saw an increase in that participation this year. Secondly, everybody knows what funds are. We found that funds were really attractive vehicles this year for one to participate in because they have the peace of mind and give you the opportunity to go in at the different times, like we said. But you have fund managers who know what they're doing and they're taking care of the monies for you. Interesting as well, ETFs this year were quite a flavor of the COVID kind of situation, because when there is volatility, these instruments allow customers to really maximize on a diversification bucket of instruments. Finally, we also saw, confirmed by our colleagues Jordan and Christian, bonds were very much in demand. Obviously, when you go into things like bonds, we would suggest you do research, you maximize. I mean, we've got weekly research reports that our team produce that we strongly recommend investors to look at because knowledge is power in these kind of things. But clearly bond prices were stressed because of the credit situation on the markets, but obviously the ongoing returns that investors want, especially those investors who seek income. And our company, Calamatta Cuschieri, is quite well positioned in that respect locally. Again, this element is something that we saw great demand for this year.
Okay, that's very interesting, Sergio. Thank you. How does one get started?
Okay, it's very easy. Basically, if you want to trade online, you just log in literally 5 minutes, an account is opened, and you're ready to start your journey online. If you want to visit us face-to-face in one of our branches, all you need to do is book an appointment. We'll take care of everything for you. We've got a process called financial planning. We're very passionate about this process because we don't just let you in, sit down and say, I want to buy a bond or I want to buy a share. We go through an exercise where we get to know your real situation, why you want income or why you want returns, what kind of risk profile you have, what level of length in the investment you're taking out you can afford or not afford. And after really getting to know you very well, we then provide you with a written recommendation on where we suggest, based on what we know, that you invest your hard-earned monies.
Thank you, Sergio. Thank you, Chris, and thank you, Jordan, for your advice, which we hope our viewers found very helpful. So much insight and so much to think about for what is definitely going to be a very eventful year. Thank you to all our viewers for watching us on Facebook. We look forward to your feedback on our various social media channels. And if you want to get in touch with us, please do so via our Facebook page. Thank you very much and good night.